I'd like to welcome all of you to the GLIO New York seminar. Really appreciate you taking the time this afternoon. We have a great diverse group here of, investment managers, consultants, allocators from, wealth management platforms, institutions, and RAs, and of course, representatives of listed infrastructure companies. And collectively, this is an opportunity for all of us to hear perspectives across the listed infrastructure asset class. And today, we'll start with a panel of investors and consultants on building an infrastructure allocation, and then our fireside chats on the future of transportation, utilities, and energy from some of the largest infrastructure companies globally. And we hope you can stick around for a reception afterwards. One thing to note, it is amazing how far this asset class has come along. It wasn't too long ago when, us and, a handful of other managers, some of whom are here today, we started the first listed infrastructure, funds. And, the past 15 years, the space has just grown tremendously. There's now more than 50 dedicated managers, more than 150 billion in assets under management. The market cap of the listed infrastructure space is now over 3 trillion and continues to grow. And it's very well recognized that the best, highest quality infrastructure assets in the world are owned by listed companies. And you'll come to find later on that, these companies are best positioned to take advantage of the major trends and investment opportunities out there in the future. And a big part of driving awareness in the asset class has been GLIO. The industry organization played a critical role in bringing stakeholders together, from consultants, allocators, managers, and of course, corporates. And so before we get into the heart of today's agenda, I'd like to welcome, the tireless and hardworking founder and CEO of GLIO, Fraser Hughes. Thank you.
Hey, thank you, Manoj. And thanks to the organizers today. There's a lot going on in the background. So thank you to Jamie and Erin as well at DWS. A big thank you to John as well at Duff & Phelps for sponsoring the event and putting together the excellent program as well. And thank you to the audience as well. I know it's difficult to come through the rain, but you're here, and thank you for attending. Okay, a few slides my side, just an update on the membership. So we're now up to 72 members globally. They come from North America, Europe, Australia. Is my mic okay? Is it a bit patchy? And Australia. So it's a truly global set of members that we have. If you look at the makeup of the members, it's about 50% corporates, listed corporates, and they'll come from regulated utilities, communications, infrastructure, renewables, energy, transportation, and transport sectors. And between them, the enterprise value is about $1.5 trillion. So it's a nice representative group. The other 50% is the dedicated global listed managers. So it's about 35 managers. If you tally up the AUM of the members, it's round about or approximately 120 billion that they manage. Where do I think we need to be in the next 5 years' time? I hope that we can grow the organization to be truly representative to 150 members. And I think that growth has got to come from the listed companies, because at the end of the day, they benefit from an increase in AUM. Okay, so what do we actually do? Put simply, we raise awareness for the asset class. So there's, maybe 2 main things that we do. So under normal conditions, we'll organize seminars around the world. So our normal annual sort of rotation is Sydney, So we did an event in March this year in Sydney. We had 100 investors in the room. It was really, really well represented. In London, again, we did London earlier this year. We had 80 people in the room. Jim Rice, who's going to speak later, Jim was one of the panel members there. In Stockholm, it's a little bit different. We actually run a lunchtime seminar. It's 20 of the Scandinavian investors in the room. New York, well, here we are today, and it's great that you all attend. And later on this year in November, we'll do an investor seminar in Zurich. So you can see it's quite broad coverage. Overall, we'll probably get 500 people coming along to our events. And hopefully, as we grow, that will get bigger going forward. A number of you, or all of you, I hope, are on our weekly, monthly, and the GLIO Journal outreach. So we hit about 5,500 contacts. And now, of those, 60% is buy-side pension funds, sovereign wealth funds, and investment managers, 25% corporates, and 15%, roughly, sell-side and consultants. If you look at our LinkedIn profile, GLIO has grown from 0 3 years ago to about 1,500 followers. And we also use my personal LinkedIn as well, which has 22,000 followers. So it's a really nice platform to get the messages of why you should invest in the asset class out there. Okay, how we measured going forward. Manoj has already touched on this. We collect on an individual asset manager basis, confidentially, their AUM every year. So they give us their AUM numbers, and then we tally them up into a total. Back in 2010, AUM amongst the dedicated listed managers was around about 15 billion. By the time we were established in 2016, we were just under 70 billion. And at the end of last year, we'd more than doubled that again to approximately 155 billion. What we're really looking for here is to attract long-term sticky shareholders into the asset class. People who are in there for the long term, people who understand the business. The target going forward, by the time I retire from this, I hope, 2030 is to more than double that again to 300 billion in AUM. Everyone in this room will benefit from that. The managers, they manage more, but also the listed corporates, because the capital flows through to them. Okay, a few slides before I finish on the key education pieces. So when we started, we wanted to prove that listed infrastructure will give investors underlying infrastructure performance. So this is really one of the first pieces of research that we did. So what you see here is the red area. That's the high and the low of the private infrastructure benchmarks. So on average, Cambridge Associates, it runs one of the private benchmarks. That will tend to be along the bottom. Along the top will be EDEC and Preqin. Okay, between the private infrastructure benchmarks, it's about $1 trillion worth of assets. What we do here is sort of draw a midpoint between the range of the private infrastructure benchmarks, and we overlay our in-house GLIO index, which is the blue line. And what you see is over the medium to long term, the GLIO index clearly tracks the private market. And if you look over a 20-year basis, listed and unlisted on an annualized basis, they return around about 10%. And we've just put global equities as an example of the green line here. Global equities round about 9%. So they're clearly different asset classes. And I think John and his panel will get stuck into this question a little bit later on. This is a piece that John and I did in the last GLIO Journal, and the GLIO Journals are dotted around the room. So please take one. I don't want to take them back to Europe, right? My wife will kill me, okay? So please take one with you. But what we do with this research is just look at the efficient frontiers of blending both public and private infrastructure. So I think the key point here is if you look at the green line, that's GLIO and private infrastructure midpoint. And what you find is the efficient frontier, it clocks out at around about 40% listed infrastructure, 60% private infrastructure. So listed infrastructure should clearly be in that allocation of infrastructure looking at these efficient frontiers. And again, John will touch on this, I guess, in his discussion. Okay, last point my side. This is another big piece of research that we do. We churn this out every month, but we look at private infrastructure valuations, so EV, EBITDA, versus the listed markets. The red line is the private market, and the blue line is the listed market. And what you clearly see is that the GLIO index, or the listed infrastructure market, clearly trades at a discount compared against the private market. So all sector averages listed is around about 11 times, the private market around about 15 times. That's a 40% difference. So in simple terms, that means you can get better value in the listed market. And again, I hope John is going to touch on this a little bit later on. Okay, and just because we've got utilities and transportation discussion, I do the same thing for regulated utilities. The dots are actually individual deals, but you see that round about 80% of the private deals happen over and above the listed market. And again, averages listed 10 times, and on the private side, around about 13 times. So again, a clear difference. We offer better value, I would argue, in simple terms. And transportation, we do the same thing. On the private side, around about 17.5 times, and on the listed side, around about 10 times. So in very simple terms, we would offer better, or I would argue, we would offer better value than the private market. So I'm going to wrap up my side. Just going back to the membership again, we need to grow, and I need your help. So please do ask your peers, why wouldn't you support this organization? Why wouldn't you support the goals of this organization? For the investment managers, when you see the corporates, give them a little push, right? Get them to get in touch. Thank you. John, I'll hand over.